Now, what I have for us today is called break of structure and shift of market structure. So let me explain what I mean by break of structure. I want to use a bullish example. I'll also use bearish example moving forward. So in a structure, a bullish market structure like this, if you see something like this already, you know that this market is trending higher. It is forming higher highs, higher lows, indicating that the market is bullish, indicating that the market wants to keep on going higher. So now a break of structure is, we call it break of structure because now this in itself like this, between here, and here, we call this a trading range. We call this a trading range. Now, since we're anticipating buys, what you want to see is you want to see that price will break this structure because I told you that between here and here is a range. Between here and here is also a trading range. So now, anytime market breaks this trading range, either to the upside or to the downside, we have what is called a break of structure. So in this situation, we call it a break of structure, indicating that the market is breaking structures and making higher highs. Like it is creating, let me just say it is trending higher. So we have a trading range or a trading structure here. So anytime the market makes this move, like it pulls back here and then breaks this structure, we call it a break of structure. For people that are not already in the trading game, this might be a little bit technical, but just stay with me. You guys will understand what I'm saying. So as I said, anytime you have price action breaking this structure here, it's simply telling you that market wants to keep on going higher. Okay, so now this is a break of structure here. Here is also a break of structure. Here is also a break of structure. That is when new structures are formed in the market. So basically, when this structure is violated, a new one is formed here. That is, if this structure breaks, if this movement here breaks this structure, you have a new trading range. So you should be anticipating that market will pull back here and then create a new trading range. Because when you look at this structure here, you can be able to anticipate what the market is going to do. Now, since you know that your market is bullish in situations like this, let's assume this market was maybe somewhere around here and you're anticipating that market will go higher. Your anticipation should be that what market will do is from where it is here, market will rally and break this structure. Now, this is how to anticipate the market. Since you know that the market is bullish, you should anticipate that when the market is somewhere around here, it's going to create a new higher high here. This is what I was saying. This is a bullish market structure. So anytime the market breaks this trading range, it is forming a new structure. So this move here is now called the break of structure. Okay. So now this is for a bullish scenario. Now for a bearish scenario, let me draw it. So anytime market breaks this trading range, what you have is called a break of structure. So the market is breaking structure either to the upside or to the downside. Here we have a break of structure. What you are seeing here is anytime the market breaks a lower low in a bearish market structure, what you have is a break of structure. Okay, so it has broken structure, and because of the fact that it has broken structure, a new structure is going to form now. So this and this is now the trading range, or we call it the current structure. Next, you want to see markets pull back into the trading range that is between here and here. Market always does this. Market will always pull back into the trading range, and then you start looking for selling opportunities here and wait for the market to break structure again. That is how the market moves. So though this is a little bit advanced, but let me just pitch it in. I think moving forward, we are going to go into that very, very in-depthly. But in this trading range here, now we call this, when market breaks this, we call it this an external range liquidity. So basically what market does is it moves from an internal range liquidity to external range liquidity. What it basically means is, let's take this to be an existing trading range here and here. Please, let's pay attention to this because it will really help us in the future. Let's assume this is our trading range between here. Now, this is the trading range. The liquidity that is inside this place, we call it internal range liquidity because it is liquidity that is inside of this existing trading range. So we call it internal range liquidity. So when it's breaking this external range liquidity, so liquidity that is within your trading range is internal range. The liquidity that is outside is called external range liquidity. Now, using the scenario of a bearish market structure, I said that let's assume this is a bearish market structure. Okay, now, and this is our trading range. Between here and here is our trading range. And because of the fact that we know that this market structure is bearish, what you want to see the market do is you want to see the market pull back into the existing trading range. Okay, so this the trading range for a bearish market structure, and inside this existing trading range, there is liquidity inside. Okay, there's liquidity. The concept of liquidity is a little bit advanced, but I just want you guys to have at the back of your minds that there is something like internal range liquidity, and then there's external range liquidity, because that's what's going to make you um, understand the markets in depthly. So the liquidity that is inside the range is called internal range liquidity. The liquidity that is outside, that is the liquidity that resides at the edge of the trading range, is called external range. Look at it, it's outside of this, the existing range. So anything within here is internal range. So market moves from internal range liquidity to external range liquidity. This is a new structure. What will market do? It will go back and tap internal range liquidity and do what? Come down and take out external range liquidity. So anytime market takes out the existing trading range, we have a break of structure, meaning a continuation. So break of structure is like a continuation in the right direction. So the right direction is if we're anticipating the market to form lower lows and lower highs, meaning a bearish market structure. If the market keeps on doing it, so that means market is continuously breaking structure. Now, there's another terminology that people normally misinterpret with break of structure. We call this one shift, shift of market structure. Now, from the word shift of market structure, or some people use either shift of market structure or change of character. Change of character, shift of market structure, or change of character. I'll explain that also. So shift of market structure. Now, the whole relevance or the essence of shift of market structure or change of character is to know when the market is changing direction. Now, we said that we want to trade market that is either forming higher highs, higher lows. We said this is a bullish market structure, right? Now, how do you know this market is ready to change trend? How do you know when this market is no longer a market that wants to keep on buying? How do you know the market wants to reverse? That's where the concept of shift of market structure or change of character comes in. So you see, from what you are seeing here, market is forming higher highs and higher lows, indicating that the market wants to keep on buying. So if you don't know when the market is ready to shift from a buying market to a selling market, you see, you might be anticipating buy while the market is showing you selling signals. And if you do that, you see, you end up losing your money. So shift of market structure or change of character comes in to make you understand that the market can shift structure and you should be able to detect it very early. So this is a shift of market structure. It happens when the market fails to make a new structure. So all things being equal, you can see this is a higher high, this is a higher low, right? This is a higher high. What you normally want to see the market do is to move into this range and then probably break this structure here. But when market fails to do this and instead it does this, you see there's a structure here. We said that there's an existing trading range between here and here. So when market breaks this structure or when it violates it, it's trying to tell you that this market is no longer trying to buy, but instead is trying to reverse because the trading range has been violated. So when this happens, what you normally see is you see the market pull back like this, and then it will start making lower highs and lower lows. This is change of character or shift of market structure for a bullish market, because the market will keep on forming higher highs and higher lows. It will keep on breaking structure to the upside until something like this happens to show you that the market wants to now reverse. This for a bullish market structure. Let me show you a typical example for a bearish market structure. So let me explain a bearish change of character. So assuming the market is forming lower highs and lower lows, indicating that the market is bearish, and then all of a sudden you see a move like this, the existing trading range, which is this, and this. When it violates it, when the market violates it and then breaks or it changes, it breaks this structure, the existing trading range, it's now telling you that this market is no longer selling, it's no longer a selling market, it's no longer a bearish market, but instead it is trying to reverse and start buying. And when it is starting to buy, the market will form a new structure. So this is the new structure you have here and here. And when you see the market doing the next thing you see the market do is it will now come down here and then create a new structure. Let me try and go into the chart and show you guys typical examples of a shift of market structure. All things being equal, this market is supposed to do something like this, maybe just do this pullback and then create a new higher high or break this structure here. like this, because that's what the market has been doing. So by market failing to do this move, but instead the market did something like this, the market broke structure to the downside. It is now telling you that this market is no longer a buying market. Instead, the market has now reversed. So you see, now forming lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. So let me just bring this out so that you see. I think this is what we did earlier. So this is our shift of market structure, telling us that this market is no longer a buying market, but instead it has reversed into a selling market. So you can see it. So it was forming lower highs and lower lows, and then all of a sudden we have a shift of market structure. Okay, so this is basically, so now we've done our break of structure. uh, for a continuation. Break of structure is more like in a bullish market structure, we have more structures. So the more structures are forming, it means that we are breaking structure for a continuation. Then shift of market structure comes when there is a reversal in the market. Okay, so that's basically the difference. So now I will try and show you guys how to identify a valid or an invalid shift of market structure, because the market can be very deceptive sometimes, can make you believe that there's a shift of market structure while there is no shift of market structure. So in a bullish example, where the market is forming higher highs and higher lows, higher highs and higher lows, and then all of a sudden the market does something like this. Now, how do you know this market is confirmed to shift structure? What you want to see is, normally, I think in the first lesson, I explained that there is a wick. There's usually a wick for every candle. So what you want to see is the last candle here. Every candle has a wick. So this is a wick here. If you see a wick to body closure when the market is closing, now you know that the shift of market structure is valid. It is confirmed that the market wants to keep on going lower, because this structure here is bullish, and you have a move that is trying to indicate that it wants to change direction from bullish to bearish. So if you see a move like this, it is telling you that it is valid. But if you see a move that is like this, where what you see is a weak to weak, okay. So this is a weak, this is a candle weak, this is also a candle weak, okay. Okay. So when you see something like this, a weak to weak closure, body closure, it is trying to tell you that this is not a confirmed break of structure. It's simply a sweep of liquidity. So it is just there's stop loss here, there's stop loss line here. So what the market would normally do is it will just take out people's stop loss here, and then it will keep on going higher. So this is to tell you that it is not a confirmed change of market structure. The structure you are seeing here is right, higher highs, higher lows, highs, higher lows, higher highs, higher lows. You see here, this is a weak body closure. You guys can see it, a weak to body closure, indicating that the market is trying to change direction. So after this happened, what do you see market doing? The market started rallying down because it is a weak body. It means it is valid. But if you don't want to even use this, if you want to use this as your shift of market structure, it is still valid. Here you have a weak body. Now this is indicating that the market is now ready to reverse. Name look for an example that is like a fake breakout or a fake shift of market structure. You see this? Someone might look at this and say that market is probably trying to reverse upward because there's a weak to from here. There's a weak body closure. Someone might see this and say that the market wants to start rallying higher. But you see, there's a weak to weak body closure. So that's to tell you that what market is trying to do is just trying to take out liquidity and then keep on going lower. It's the same thing with this one here. This is weak. Okay, you see, this is weak to weak. You see this weak and then this weak. Someone might see this and say market is trying to reverse. But in reality, it only took out liquidity and then is continuing in that direction. Let me try and look for one more example. You see, all of these are examples. All of this is week to week, this week to week body closure. So all of this is not a valid shift of market structure. It's the market is just trying to take out liquidity and then continue in the direction. Okay. So this is what I have for us on this session. I don't want to take too much of our time.